Josh, Happy New Year. Good to see you again. Do you think that the Fed, in one way or another, is going to screw up this stocks party, for lack of a better term?
Well, good morning. I think no matter what they do, someone's going to say they screwed up. I don't think they will. I think they've been very forthcoming about where we are, and they've certainly admitted some mistakes around their view of inflation, whether it was transitory or transient or temporary. So no, I would agree. I think they are highly sensitive to ruining the economy, ruining this great run in the stock market. But I think they're aware of that, and I think we're aware that they're aware.
Yeah, does it change the way you look at your portfolio or the way you invest, Josh?
Well, it's a great question because that's what really matters. I mean, the Fed, they do what they do, and we have to kind of react and adjust, or maybe not so much. So I would say a couple things. One, I think the earnings growth story is solid. I think the economy obviously is on a nice growth trajectory. I think it will slow quite a bit this year, but that's inevitable in a lot of people's view, including my own. I would say it's a multiple story. So what are people willing to pay for earnings? So, multiples are maybe slightly stretched in certain parts of the market, certainly some of the growthier parts of the market. And so it brings me back to things like utilities, where, there's a relative lack of business risk. There's, consistent and somewhat predictable earnings growth. And certainly just, I think there are fewer unknowns when it comes to something like utilities or any name like a utility.
We're making a big deal about the 10-year bond yield move, maybe as we should, Josh, because it has been pretty violent and pretty rapid. But context is key. The 10-year yield at 1.73 is just back to where we were last April. It was at 3%, by the way, back in September of 2018. So we've come up, but we have been a lot higher even in just the last couple of years. What do we make of that move? Something to worry about?
Yeah, it's a great point. It's easy to forget because I think we were at 1.3 a few weeks ago, and it seemed, there was a case to be made that it would go lower. So I agree with you. I think putting it in context, we're still, we're going to have negative real rates for quite some time here. Whether the Fed raises 2, 3, 4 times, certainly the short end of the curve and out in 10-year land, it's going to be negative for quite some time. Very accommodative, very much, easy money. That's here. It's not here to stay, but it's here for a while. So that's been giving a bit to the market, quickly, and will
Josh,
continue to.
We like to call them Opportunity Fridays here, give investors and our viewers and listeners actionable ideas every single Friday. Well, every day, but really on Fridays. You mentioned utilities. Any of those you like more than others?
Sure. Yeah, I would point out, Sempra, as well as Southern Company. And so, it's a bit of a yield story and also a multiple story. And just, utilities had a good year last year. It was not S&P 500 good. It was about half that. So we're looking for a little bit more mind share around utilities, the dividend growth story, a compelling multiple. And also in a name like Sempra, there is some exposure to LNG exportation, which is a story that's been well covered. Spot prices in the U.S. versus abroad, that spread is quite wide. And a push toward electrification, which is in its early days. But when that takes hold at some point, I think there's a little bit of a wind at the back of utilities that wasn't there before.